Hello, Jive traders! So, not stocks, not crypto. The trade of the week is gold. Gold has been on a very strong run. Over the last trading sessions, prices have rallied hard. What's behind this move? In my personal opinion, it's a mix of dovish expectations from Fed, weakness in the US dollar, and the classic safe haven demand that gold attracts when global risks are front. I usually track and trade gold through GLD, the SPDR Gold Shares ETF. GLD is the largest physically backed gold ETF in the world. Each share represents a fractional claim on actual gold bars held in worlds. That means when you trade GLD, you are essentially trading the spot price of gold itself. This week, GLD finished around $331, which is a brand new all-time high. But as an options trader, the price level is only the first part of the story. The second part, which matters even more for strategy, is implied volatility. And here, the key metric I watch is implied volatility rank. If you don't know, IV rank compares today's level of implied volatility with where it has been over the past year. If IV rank is low, it means options premium are cheap compared to the history. If IV rank is high, it means premiums are expensive. In gold, volatility is usually very low, often IV rank is in single digits. And right now it sits at 31, and that's really elevated. That tells me options are expensive, premiums are rich and juicy, and this is a rare environment where selling premium in gold actually makes sense. But before I walk you through the specific trades, let's put the macro bullshit together so we understand why gold is moving. From September 2nd to September 5th, GLD went from 325 to about $330. And also volume was climbing into Friday's close. I personally see there are three macro drivers here. First driver is, of course, the Federal Reserve. Back in July, the Fed paused interest rates at 4.25 to 4.5%. Powell highlighted risks to the labor market and left the doors open to rate cuts. The market now puts an 89% probability on a 25 basis point cut at September 17th meeting. When real yields fall, holding non-yielding assets like gold becomes usually more attractive. That's why dovish Fed signals are usually bullish for gold. Second driver, the US dollar. The US dollar index dropped to 97.8, a 1 month low. Over the last year, the correlation between gold and the dollar has been very strong and very negative. It was about minus 0.82. That means when the dollar weakens, gold rises almost like a mirror image. And the third driver is maybe safe haven demand. As you know, the US fiscal deficit now sits at 126% of GDP. Political pressure on is growing. And on top of that, conflicts in the Ukraine and in the Middle East remain unresolved. These combinations keep pushing investors into gold. We can see it in the flows into ETFs like GLD, and we can see it in central banks' activity. In fact, central banks in Asia and in the Middle East continue to swap dollar reserves for physical gold, and this is a very strong long-term tailwind. All right, with that context, let's move to the trades. I will show you my three setups. GLD call ratio spread, GLD short strangle, and forward slash GC short strangle using, of course, gold futures. For each trade, I will give you the structure, the premium collected, maximum profit, probability of profit, your initial theta per day, and the buying power required. So you can see exactly what the trades look like. Okay, so here is my trade idea number one, GLD call ratio spread. Uh, the structure is to buy one 345 call and sell two 350 calls, all expiring October 17th. My premium collected, my initial premium collected is about $123, but maximum profit is $623 if GLD finishes right at 350 on expiration, which is of course not likely. But general probability of profit for the trade is very high, is 87%. And my initial theta is about $6 per day, and it will be increasing. Buying power requirements, if you don't using portfolio margin, is between $6,000 and $7,000. Now, let's talk about what this means. A ratio spread is not a bullish trade. It's actually neutral to slightly bearish. The reason is that you are short one extra call. The best case will be if GLD drifts up a little bit, ideally to 350, and then stops there. If gold moves aggressively higher above the break-even around $356, then the trade can start losing money. So the risk here is entirely on the upside. And that's why I never trade this set and forget trade. If GLD passes through 350 strongly, I will adjust, and you can learn more about my go-to ratio spreads adjustments from my trading plan below. Now let's go to my second trade idea, which will be GLD short strangle. This one is more straightforward. You just sell 315 put and 350 call, both expiring October 17th. Your premium collected will be about $390. Maximum profit also $390, which is the credit received. Probability of profit is about 70%, and initial theta per day it's about $12. If you are not using portfolio margin, buying power requirement will be about $6,600. So this is the classic premium selling trade. You make money if GLD finishes between 315 and $350 at expiration. The risk, however, is unlimited on both sides. If GLD falls far below 315 or rises sharply above 350, the strangle can lose heavily. And how do I manage this? First of all, I take profits early, and if one side gets tested, I roll the untested side and adjust. I can also neutralize delta, hedge with another position, and in my trading plan I share more tips and tricks about strangle management. Now let's go to my last trade idea here, which would be in forward slash GC, which is gold futures short strangle. So we are looking at the futures market, and here I'm selling the 3,450 put and the 3,900 call, both options expiring October 28th. My initial premium collected is $4,500. Maximum profit is also $4,500. Probability of profit is about 72%. And theta, you can see, is really high. Initial theta is $115 per day, and buying power requirement is between 14 and $15,000. So as you can see, this is the same structure as the GLD strangle, but the scale is completely different. You can see that the buying power required is larger, but look at what you get in return. $4,500 of credit compared to only 300 or 400 on GLD, and the theta is also much larger, for 115 per day versus $12 per day on GLD. So in dollar terms, the futures strangle pays much more for margin used. But as I said, it's better for larger and more aggressive portfolios, because futures give you more leverage, but this leverage cuts both ways. The gain can be large, but so can losses be if the position moves against you. So to summarize, gold is at all-time highs. Implied volatility is elevated. Premiums are juicy. This is one of the best environments in years for selling premium in gold. But these are not set and forget trades. Please remember that active management is required and position sizing is critical, and you can learn more details about setups like that from my trading plan. So thank you for watching. This is how I am trading gold right now. And if you want to see more trade ideas and my live portfolio updates, please subscribe